huge task it is for the institute to conduct exams and produce results. We don't even realize results come miraculously. The effort behind it, I think it's as much as the Indian general elections. It's a huge logistical issue and very, very honest. I think I will already do it thanks my again good friend Rakesh, who was the earlier speaker. You heard him very emphatically replying to all your questions. I'm not sure I'll have the same authoritative manner in which he explained some of the provisions, because the chapter which I'm dealing with, accounts and audit, is still so nebulous. Just by way of history, I know this Companies Act, everybody has talked about it. It's had its evolution over the years. There have been numerous companies bills. I have personally appeared before the select committees of the Parliament, including the Veterans Committee, which dealt with this bill. It's a very interesting process, and in the past, whoever took up the bill, the minister lost his job. Finally, piloted by a pilot and seen the light of the day. And met Sachin Pilot too on numerous occasions. Last was in February, pleading with them, saying that there are provisions related to accounts and audit, which actually are retrograde and which cause a lot of damage to the profession. And that's why I don't call this the Companies Act 2013. I call it CA 2013. It only impacts chartered accountants. Of course, it impacts private limited companies, and the profession of company secretaries have realized to their horror that it is impacting them also dramatically. So is with the Institute of Costs and Works Accountants, now called ICAI also. So, all in all, what has happened is the provisions, I think a little bit of background again. There is a gap between intent and its drafting. When it went to the Law Ministry has made some changes without understanding the implications of those changes of mind, and which has caused serious problems insofar as particularly to deal with audit. The second thing which has happened is, yes, this Companies Act in over 300 places says rules as may be prescribed. Now in some cases the rules have gone beyond this, and that is where it is a challenge today. And the third situation which we are constantly having is, for the first time perhaps, definitely for the first time so far as magnitude, the law has moved away from accounting standards. And that itself will cause a lot of problems in my opinion. Even 2 days ago we were with persons of the Accounting Standards Board discussing certain implications. And we are very clear that even a thing like definition of subsidiary is causing huge problems. And this is a matter of concern. Because when you are dealing with accounting, you should leave it to accountants. Accounting standards is something which is evolving. And we are trying to align with the best practices across the world. Maybe we will go to IFRS or its equivalent in days very soon. But irrespective of that, you cannot have definitions in the law which are inconsistent with the accounting standards. I'll take you through. And finally, which is rather two things. Again, I keep taking these matters up to the ministry at various levels. Even in May, before the new government came and I went to the minister, I said, here are cases in the Companies Act which has brought business to a standstill. No, law should encourage business. You punish, but the law can't be only on punishment. The very purpose of the Companies Act is to administer companies and to facilitate business. It can't bring business to a standstill. It caused chaos to private limited. It caused chaos to deposit accepting companies. It caused chaos in the bond market and debentures when the provisions of creation of debenture redemption reserve were not clear, or their rules did not come out. Particularly housing finance companies were not covered, and they raised something like 80,000 crores by way of debentures. And you can't expect them to create 40,000 crores of debenture redemption reserve. It's ridiculous. Drafting issues. But the point is, it brought business to a standstill in some cases. Deposit accepting came to a standstill because of credit insurance, requirement to have credit insurance cover. Insurance Regulatory and Development Authority says we have no such product. The FCI is prescribed with the manager. But the company has to comply with the law. How can they accept or even review a deposit? Because the law says it has to. You cannot do it unless the deposit is covered by insurance. How do you do it? So it brought deposit renewal to a standstill. Then one goes to the ministry says, oh yeah, we understand, we'll have to take up the data. But when? You already notified. And when I come to the sections I will also show you. Last week of March is when they notified the provisions relating to accounts. A depreciation. Depreciation then becomes law from 1st April. Now if you see the depreciation schedule which I will take you through, it has changed in concept from trades to useful lives. It has prescribed transitional provisions. It's also on componentization. All of it, and if you are a listed company, you will have to do it in the first quarter theory. Can you do it? It requires a huge effort for large companies because you have to change IT systems. And everybody will have thousands of assets. And every asset, if you have to compute in accordance with the transition provision, the rate of depreciation will be different, depending on the year in which the asset was put in. It's a huge exercise. And you announce it on last week of March, and then say it applies, because as far as the Companies Act is concerned, as far as ministry is concerned, it's the next year end only. 1 year time you have. But if you are a listed company, you don't have 1 year time. You have 3 months time. Now that's another matter we are taking up with SEBI. Saying, hey, look, this is becoming difficult. Can we in the first quarter do something different, or the first 2 quarters? What do we do? Because we can't tweak the IT systems overnight. Because the first 3 months of the year, you are busy closing the last year's systems and preparing the results. You have to get that right. So, broadly, now what has happened? What is the mood? Everybody is fed up with the numbers. On 21st of this month, there was a program in Delhi. The new government, the new minister, Nirmala Sitaraman, wanted to meet all stakeholders and understand the issues affecting the issues arising under the Companies Act. Because even Mr. Arun Jaitley was fed up. Everybody was coming and complaining. Nobody came and appreciated. Everybody wanted to complain. So he said, this is too much. Something has to be done. Let's have a meeting. So on 21st there was a meeting. I was asked to speak, but I was abroad, so I couldn't. I am told there was chaos. In the sense, all the 3 large industry bodies unanimously criticized. They tore the Companies Act according to reports. There was nobody to defend even from the because unfortunately, the person who authored it, the lady Renuka Kumar, has done a great job in my view. You shouldn't try and criticize merely because the person is not there. She is completed her term. But the point is, there is no one to defend the Companies Act. They are also at a loss. There are some issues so far as drafting. You would have all learned it when you heard the speakers all through the last few days. And they are at a loss as to how much can you do under section 470, which is the section where you can notify the power to remove difficulties. You can do notification, remove difficulties again. You can't change the entire structure of the act through the power to remove difficulties. They have done some notification. But they are also at a loss. And industries are unhappy, professionals are unhappy, industry, both big, small, private, public, all are unhappy. Multinationals are unhappy. And this government wants to say that, look, we must now give fillip to the economy. How do you give fillip to the economy? Judiciary is unhappy. National Company Law Tribunal, which is supposed to be a creation of this, also cannot be created. That's also a big dispute. Also a dispute, which is an old dispute also, as to who will be National Company Law Tribunal. Will it be judicial members, judiciary, or will it be IAS officers? Judiciary is very clear. It's a body which takes judicial decisions. So you can't have IAS. And they believe that once this IAS people say judiciary, there is no bandwidth. So we are also good people. So they also want a position there. This fight is going on. Profession is unhappy for a variety of reasons, including the fact of creation of National Financial Reporting Authority, which virtually takes away everything from the Institute of Chartered Accountants. That's a view, and that's a concern for professionals, for all of us who are chartered accountants. Sure, our pride is hurt. When every power which is there since 1949, which we had, is taken away by somebody, we don't know who will be sitting in the chair, and the law clearly says anybody in practice cannot be a member of an authority. And what do? There's somebody who's going to go administering you who is not a chartered accountant, may not be a chartered accountant in practice. Now, this is the current scenario. We will see changes in my view. My view is that we will see some changes coming. I'm told July, news channels say July 1st, 2nd there will be an announcement. Personally, I doubt, because Nirmala Sitaraman has to get elected to the Rajya Sabha, and that process is on July 5th. So then she's a minister, all right, but she has to now get a seat in the she's not an elected member, as yet to the houses. So, but clearly, there's enormous pressure. There is a draft notification on private limited companies, which Mr. Kirit Somaya, I understand, to come again because of chartered accountants taking the initiative, rightly so. So there's a draft notification for public comments. Based on public comments, that will be final notification. And all of this, including the rules, mind you, for the first time were exposed, and there were thousands of comments. Somebody in the ministry said out of 11,000 comments, 10,000 were identical. Because one person wrote and everybody uploaded it independently from their email. So maybe they lost interest, whatever it is, but I don't find a dramatic change in the rules as a result of many of those things. I didn't. To some extent, I was involved in the rulemaking committee. I saw the rulemaking committee, how they worked, and who were there, what they were doing. The process seemed good, but the product is not necessarily the best. One would expect, maybe because it's been dominated by, not by chartered accountants, but chartered accountants. Maybe that's one of the reasons. But definitely, we also need to consider the mood which is there current, which has been there in the background, into which some of the provisions relating to accounts and audit. I always say that we can debate over wordings. Wordings can change. But we must focus on the principle. If we accept the principle, then it's only a matter of time before that principle will get extended. And I say this in every program I speak on. For professionals, all of us, let us not look at the Companies Act saying, oh, this provision doesn't affect me today. If it doesn't affect you today, it will affect you tomorrow. Look at the principle. What is it trying to drive? What is the principle? If that principle says, and the application of the principle is today to a certain set of companies or to a certain set of auditors, tomorrow its application will be extended to a larger set of companies and a larger group. Because you've already, that principle is cast in stone. You've already accepted the principle. It can be both ways, meaning with certain principles provide opportunities. Like in 1980s when tax audit came in, it laid down a principle that yes, there shall be a professional who will issue a tax audit report. Then it's only a matter of time before the threshold, whether it is 40 lakhs or 10 lakhs or whatever it may be, can get correct. That provides an opportunity. Similarly, if you accept a principle of, say, punishment of the firm as opposed to the member, then for the fault of one member in the firm, maybe the entire firm gets punished. That's a principle you accept. So I'm just giving you illustrations. When you focus on provisions, don't look at it in the context saying, oh, it doesn't bother me today. Look at it in the context of the principle, and then definitely how it impacts today and what it would mean if it is extended in some way. I have a lot of slides. I know I have time till 1:30 if I go, but I'll take you through definitely the key provisions. As with any act, you will need to look at some definitions. Because when we read the act, we will assume that the wording is what is the same as it is. It is never the same unless you go down to the definition. And this I'm reminded of my illustrious predecessor, Mr. M.P. Sarda, used to say. And when he used to talk of IFRS, he used to give us a joke, which is his pet joke. And let me put that in the context of definition. He used to say in IFRS, the words don't mean what you read. It is different. And he gives the example of one day he was going near Churchgate station, I am told, there was somebody selling chicken samosa. And Mr. Sarda was intrigued how he was selling chicken samosa for 25 paise. Of course, it's a different matter. Sarda is a vegetarian. But in the joke, he says, claims to have taken the chicken samosa, eaten the chicken samosa, and told him there is no chicken in it. Why are you calling it chicken samosa and cheating people? He says, nahi. He asked Sarda sir, आप कभी गोल्ड स्पॉट पिया है क्या? गोल्ड स्पॉट में गोल्ड है? नहीं. So what is it? So similarly, sometimes when you see a definition of free reserve, you have to be careful as to see what is that mean. So that is the context. So don't get carried away by the normative. That's why I will touch upon some definitions which are very important. Then the usual provisions of accounts and audit. And so I won't spend time on background, except that I spoke about the draft notification. Now this draft notification, which is out for public comments, as you will see, this whole section 185 loans to directors, which caused a lot of trouble, which is there, has now, they say, shall not apply to private companies. If this notification goes through, it hopefully provides relief to private companies. Same thing to related party transactions. There's a huge issue with related party transactions. And I'll come to that definition of relative. I went to Sir Pilot and told him this definition of relative is a huge problem. He said fundamentally when you're talking of relative, anybody relative, fundamental to these provisions should be either control or influence. And when you're talking of relative, it has to be financial dependence. My father is not financially dependent on me. My son-in-law may not be financially dependent on me. How can you expect me to comply with certain provisions? Can I ask him that information? My brother is in the United States. I don't even know what he does on a daily basis. So the principle, he's not even financially dependent. So I said, how do I comply? I told the minister. He says, Mr. Ramesh, you seem to have a large family. I said, no, that's not. I don't have. You seem to be so worried. But this is one of, therefore, for private limited companies, they've removed this. They're hoping to remove related party transactions, managerial remuneration. There was this concern about limits on auditors. That the limit of 20 companies included public-private equity. As you know, the old law, 20 companies were public companies. Within that, 10 companies above a certain size, private companies were excluded. Now in the new law, they said audit of 20 companies, no public-private distinction. So effectively, it meant a huge shrinkage, reduction, whatever it is, and if you did a calculation, we have overall, even joint stock companies, we may have about 1.2 million joint stock companies. Now you divide all that by, divide that by 20, whichever way it is, look at how many auditors you require, how many are in practice, how many are in tax practice, and what it is. Even that arithmetic will fail you. So we had to say that there is an Institute of Chartered Accountants regulation. It says you can't do more than 30 audits. Respect that, allow the profession to regulate itself. You put some limit, no problem, but don't dramatically change it. There are multiple views of it. But now they have excluded private, the intention seems to be to exclude private companies. Let's see how that was done. There was an issue on restriction of powers of the board. So this is a most recent development, maybe a week ago. Now let's come to definitions. Financial statement definition, don't bother. It just says balance sheet, profit loss account, cash flow, nothing to worry about. Financial year, now they have mandated an April to March financial year. You cannot have a different financial year. You will require permission to have a different financial year. They will grant it generally if you are a subsidiary of a parent company incorporated outside. Now, everybody within a period of 2 years has to correct their financial year to become an April to March financial year. Whether it's a welcome provision or not, multinationals may have a different view, but in reality, in the past what used to happen, when you say profit loss account for the year ended, the year depended on the profit you wanted. You will make an 18-month year or a 6 months financial year. You say there is a problem, let's extend the financial year to 20. So all those things are not possible. That's a welcome change. Anyway, for tax also it is April to March, so it's a very, very positive development. No issue of foreign company, electronic mode, I don't want to get into these complications. There are complications as to how it becomes a foreign company. But free reserves, this is causing a bit of a problem. Now free reserve definition is dealt with in various sections. It's used in section 63 when you're dealing with bonus shares. It's in section 68 when you buy your own shares, buyback. When declaration of dividend you have section 123. And there is loans and investments to do the computation based on capital and free reserves. What is the issue? It says free reserve shall mean all reserves as per the latest balance sheet of mine, but what it shall not include is any amount representing unrealized gains, notional gains, or gains on revaluation of assets. Now, if I sell goods on credit and make a profit, isn't that a profit? Can one interpret it and say it is unrealized gain? Question. The intention, this is where I made the point of difference between intent and drafting. The intent is that when you were, if you are moving to IFRS and there is fair value accounting, government did not want fair value gains to be distributed. They said it's notional, fine, that's a view. But in trying to draft, they said unrealized gains, notional gains, or revaluation of assets, whether shown or reserves or otherwise. Means whether it is reserve or whether it is P&L, how will you compute? And what do you mean by unrealized gains? In my view, logically it should only be unrealized gains. Could be gains where you take some credit to reserve arising out of mergers or amalgamation. You take credit reserve arising out of revaluation, which is unrealized. You have mark-to-market gains, and which one can debate it could be notional or unrealized, whichever way you put it. But it's covered by the notional issue. That would have been, and we'll look at the next one. Any change in the carrying amount of an asset or liability recognized in equity, including surplus in the profit loss account, and measurement of asset or liability at fair value. Now we will move to fair values. In a way, we are on to fair value in some way. If you are on current investments, you have to, if it's lower of cost or realized value, inventories is the same. Aren't you in a way bringing it down to the market value? Forex assets and liabilities, you all at the year end, at the balance sheet rate, the balance sheet rate. In a way, it is fair value. So does it mean you exclude all of them? Any change in the carrying amount of assets? Again, back to how will you do the computation? Why do we need to do this? And this is tucked away in the definition. We need to. Similarly, when you look at net worth definition, we all understand net worth. But it says you should exclude reserves created out of revaluation of assets. Fair, it's been there. But look at the next one, next two rather. Reserves, whatever, right back of depreciation. After all, I have an asset of 100. I provided depreciation on straight line basis. I changed to written down value basis, or the reverse. I had provided depreciation of 60, I reversed 20, now it is 40. Isn't that 20 again? Why should it not be part of net worth? Had I always depreciated on the WDB basis, I would have had that same net worth, you would have allowed. It's not notional. And similarly on amalgamation. What is it in amalgamation? And not on fair value here. So it does not include reserves created out of amalgamation. In amalgamation, I get a value of an asset, I pay a certain consideration. The difference is capital reserve or goodwill as the case may be. I have a capital reserve. Why should the reserves created in amalgamation be excluded? I think there is no thought which needs to go around this. But again, this may be a long history definition. But net worth does exclude all of this. Relative and related party is the core. Why I brought this here? Not because I am discussing related party transactions, because the provisions relating to audit are impacted dramatically by this definition of relative. If you see, there are multiple things insofar as this is related party. Everywhere it says director or relative, and look at relative. It used to be 15 levels. So after we made all that noise in the ministry, everybody went and made noise. They said, now why are you making noise? We brought it down to 9 levels. But I said, look at that principle. There is no mention of financial dependence, no mention of control, no mention of influence. Father including stepfather. So if your stepfather buys shares in a company of which you are the auditor, you are gone. As if your stepfather will obey you. Or for that matter, son including stepson, daughter's husband, brother including stepbrother. Why this mindset of brother? Leave the definition of relative to accounting standards, where the principle of influence is there, dependence is there internationally. Now this is pure blood relationship, and some is not necessarily blood, it's marriage. So when you really come to the provisions of auditor independence, auditor appointment, you will find if you have to go conduct your son's or daughter's wedding, you have to check the spouse, proposed spouse's holdings, what securities you are holding. Do you have any loans from any of the companies in which I or any of your... How will you do that? Why? And this is what I was trying to drive home. It should have been very simple. If it's father, mother, if they are staying with me, fine. And the point I'm still trying to make is, I would like to comply. You frame a rule, I don't mind, I would like to comply. But tell me how. Is my brother obliged to disclose his financial interests? Why should he? You tell me, can you honestly go and ask your brother, please give me all your investment details? You tell me. Or, in some cases, your daughter's husband. Please try it and see. If you get a response, it's very good. But I am not sure you will get that response. Pardon? I didn't get you.
He will send the daughter back.
He'll send the daughter back. Okay. This was one investment I made, you can have it back. Holding and subsidiary company. This has cost a lot of money. The definition is, first, not so much, there's one requirement in law, you can't have more than 2 layers of holding companies. Why? They said unless it is a requirement of law of a country incorporated outside India. In infrastructure industry, every road project is an SPV. You will require multiple. So this does come into it. The intent was to ensure that there is visibility. If there are too many layers, they say funds will flow, you will lose track of the funds. But for the sake of the few, you don't change the law in such a dramatic manner and impact everybody else. If you are an automobile company, you will have subsidiaries. You will have a subsidiary for engine, you will have a subsidiary for gearbox, you may have a subsidiary for body, because you will have different joint ventures also. You don't want an engine making company to get involved in all other aspects. They will have a joint venture only for engine. Paint company will have a joint venture. In automobile, for a paint, you may have a joint venture. They have got nothing to do with engine technology. Anyway. But the killer is the definition of subsidiary. What it says is, subsidiary shall mean, the second part, exercises or controls more than 1/2 of the total share. Total share capital means equity plus profits. Now the earlier definition of subsidiary and the accounting standards definition of subsidiary is 1/2 of the voting power. Effectively it is equity. Preference capital is in substance a debt. Primary. So we have said that look, why do you have to do this? The ministry said, no, everybody is structuring in a manner and getting around by having more preference capital. I said, so what? They said, no. It is, after all, they control. Now, in reality, what happens now is if I have a company, if I have invested in a company, I have invested 100%, let's say I have invested, company's capital is 100. I have invested 100. That company has raised preference capital of 900. Total capital is 1000. I have not invested 1 rupee in preference capital.